Let's take one more example. Suppose there were three partners, A, B, C, and they were sharing profits and losses in the ratio of 5:3:2. And this was the balance sheet. A is capital 40,000, B is capital 40,000, C is capital 40,000, and the total was 1,20,000 rupees. And creditors on the liability side were 10,000 rupees, and the total was 1,30,000 rupees. On asset side, sundry assets 1,20,000 rupees, profit and loss account 10,000 rupees, and the total was 1,30,000. And these partners decided to change their ratio to 2:2:1. I mean to say, their old ratio was 5:3:2. Now the new ratio is 2:2:1. So what will be the accounting treatment? You know, when there is change in the profit sharing ratio, first of all, what we do, we distribute all the accumulated profits and accumulated losses. I mean to say, all accumulated losses and profits in the balance sheet, they are distributed among the old partners in the old ratio. So on liability side, there is no accumulated profit. I mean to say, no general reserve, reserve fund, profit and loss, etc. But when we look at the asset side, there is one item, profit and loss account, 10,000 rupees. You know, if profit and loss account is lying on the asset side of balance sheet, it means this is the accumulated loss. It means last year or 2 years ago or 5 years ago, whatever it is, there was a loss in the firm, and instead of transferring this loss to the capital accounts, the firm decided to keep it in the balance sheet. So this loss will be distributed in the old ratio. And what will be the general entries? A is capital account debit, B is capital account debit, C is capital account debit to profit and loss account. And the amounts will be 5,000, 3,000 rupees, 2,000, and to profit and loss account 10,000 rupees. You know, profit and loss account was lying on the asset side. It means it was debit. Now what we have done, we have credited profit and loss account. It means the profit and loss account is finished, and capital accounts have been debited. Naturally, they will be reduced. Now prepare the capital accounts. By balance BD, 40,000, 40,000, 40,000. To profit and loss account, 5,000, 3,000, 2,000. So balance CD, 35,000 rupees, 37,000 rupees, and 38,000 rupees. Now what will be the balance sheet? On liability side, 35,000 rupees, B is capital 37,000 rupees, C is capital 38,000 rupees. Creditors 10,000 rupees, sundry assets 1,20,000 rupees, and the total on both sides will be 1,20,000 rupees. It means the profit has been distributed among the partners in their old ratio. Now profit and loss account is missing from the balance sheet. It means it has been transferred to capital accounts.